Good afternoon. Welcome back to Hurdle Rate. For this video, we're going to build a DCF model for Caterpillar from scratch. As we can see on the chart here, the company is trading at near all-time highs, and since the last year, since the Liberation Day tariffs in April, the company has soared. It's nearly tripled in value. So let's build a DCF model and see what the valuation could be. So come onto your spreadsheet and open up the SEC website. Sorry about that. So we search for Caterpillar. And what we want is we want the most recent 10K, which should be at the top if you go by all annual, quarterly, and current reports. This 10K only shows for 2025 and 2025 and 2024. So we also need to pull up the previous one, which is down here. So open those up and come to page for the 2023 and 2024 one. Come to page 31, and we want to break down the sales and revenues by segment. We have to do the same for 24 and 25. Come to page 32. Then let's move on to the spreadsheet. The first things we always do, we remove the grid lines. And we're going to freeze the first two panes. So freeze up to column B. Make your A column smaller. Make your B column larger. And in cell A1, we type CAT, which is the ticker for the company. Go on data, go data types. We want this one, Caterpillar NYSE. Freeze the column. Yep, there we go. Perfect. So let's start building. Initially, as always, at the beginning of each build that we do, we also have to do a little bit of formatting. I'll explain what we're going to do each section as we get there. The date today is the 22nd of February, 2026. Sorry, ticker is okay, equals A1 dot ticker symbol. And the date today is the 22nd of February. The current price equals A1 dot price. And the implied and the upside downside we leave for now, because once we know what our valuation is, we can insert that. Just highlight to about N. Fill this with the navy blue. Font color here needs to be white, so see it. Assumptions. We want to go revenue segments. And we're going to, these are the revenue segments. So construction, industries, resource, industries, power, and energy. And this is one that we want to look at, especially with data center build outs. This one should be, well, theory, absolutely booming. And it's probably why the valuation is so high right now. Segment. But this one, corporate items. Elimination. for this one, instead of breaking these two down, we'll just go financial products revenue. We're doing the free cash flow to the firm, so we're going to use the operating income instead of net income, which would be free cash flow to equity. So this is we're calculating the unlevered free cash flow that's available to both the debt and equity holders. The WACC is the weighted average cost of capital, but I'll show you how to build that when we get to it, and the terminal growth value, which again, we'll sort that out when it's usually about 3%. But we'll sort that out when we get to it. Let's focus on the first part. It will be the revenue. So this is revenue. Start in 2023. 2023 plus 1. There we go. We're going to go up to 2030. Yeah, we're going to... No, we're going to go 26, 27, 28, 20... Yeah, we're going to go up to 2030. Means I can zoom in a bit more. Yeah, that's good. Let's just format first. Want number, remove the decimal places, use the thousand separator and brackets for negative numbers. Go. And here we're going bare, base, full. Okay, let's start. Come on to 2023 first. Construction industries 27418. 2024, it went down 25455. 25060. Convert this to percentage. Okay, so going forward, let's say that this starts to come back into growth. Theoretically, there should be a fair bit of infrastructure spend in not just the US, but Europe and emerging markets as well. So yeah, let's say it goes to 1%. Maybe let's put 2% equal, and then we put 1% here. Rather than taking an average of this minus 7% and minus a negative 2%. Okay, so to calculate what we want to put here, we're going to take the previous year minus open brackets, the previous year minus the final year, divided by the final year minus previous, well, the year that we're looking at. So close bracket, and some of this that we need to lock in. So 2030, this one will always be the same. So we lock this one. This one, the row will always be the same, but the column will be different. So we just lock in the row. Then for these, it would be, this one would, forgetting, it would be the column, but not the row. There we go. Pull that along. And let's put base being 95%, 105%. Lock in. There we go. Multiplied by I10, I think it is, isn't it? Let's put 2 in here. And that's our base case when we put 2. So we want to be able to flick between these switches, 1, 2, and 3, and it will simulate the different growth forecasts, whether it's 1% or 0.95% or 1.05. To do that, we use a function called offset. So we select the cell that we're in this case F27. We select our switch. Right, it was C10. But lock it in. Then another comma, then just put 0 afterwards. Then just need to sort the formatting out. Again, sorry, I'm using the browser version of Excel, so the shortcuts are not the same. Now, to forecast these projected revenues, just go equal to your previous year, multiplied by 1 plus your growth rate. There we go. So that's the first section done. Equals B, what was it? 11. So the resource industries 2023 was 13,583. Then 12,389. 2025, 12,474. I mean, ultimately, for total revenue, we're anticipating it to be probably maybe 6-7% growth for 2026, and maybe by 2030 we'd see it going to about 4.5%. But I think a lot of this is going to come from power and energy. So let's see how it looks first, and then we'll tweak it to get that overall being in that range. 12,474. We'll probably actually put 2% here, just because there's obviously a huge need for mining at the moment. So Yeah, we just need to make sure that everything is in the right cell. Go a bit, say a bit higher. Yeah. Segment is foreign energy, and this one is, I guess, going to be the real driver of they put it something of the company because of the data center requirement. And this is probably where a lot of the future growth is. Actually, no, they do have a lot. They do have a huge backlog of orders, which is what they said in the most recent annual report. So put construction industries. Let's put this up to 4. Let's say 1.5 here. 20, 32,201. And let's imagine that it does keep growing at that same sort of level. So let's put 10%. We'll say it goes to 7.5. Well, and just make sure it's on the right switch. But this one put 90% because it's probably the more volatile because it's all dependent on the capex spend by the and the data center spend by the big tech companies. So yeah, there's a lot of room for the between, I guess, the bear base and bull case. Okay, now I haven't shown you how the switches work yet, so let's look at the construction and industries. Now this is on the base case. We're projecting these revenues on on the base case, but let's say we go a bit bearish. We just change the switch to 1. And remember these numbers here, the 28,695. See, it comes down to 28,504. This becomes the growth rate instead. And we can flick between all of these for all of our revenue segment to project out what the revenue is going to be. For all other segment, this is a very small part of the company. And let's just put within 20 minus 5%. Go. This one's a bit annoying because it's really irrelevant, but I have to put them all in. That's what is on the different 4. Let's just leave it at that. Bit of 0 here. This has to be 105. When it's negative numbers, you have to switch the bear and the bull around. Go. Again, this one we just go negative 5 billion. Negative 570. Negative. Again, we'll just use this. Go. Now we're on to the last segment. Potential products, and just use this line. 3785. When the numbers are different, I mean, this one is fine, but when they are, just always use the most recent financial. 4053. Go. Just use the average. Again, yeah, and we'll put this to say 5%. And this is when it sells its machinery on, or when it helps finance to their buyer. Put it to 6. It's not a large part of the business. It is one of the ones that is growing. Yep, that's good. Okay, so this is all of the revenue segments built out. So we can now sum do the total sum. Total revenue. Let's sum all of these together. Sum. Yeah, so that's about right. Not about right, I mean, we don't know. This is sort of within consensus of what 2026 is going to be. It's going to be about a 6% growth here, but this should be lower, and here we should be expecting about 4.5. So let's just make a few adjustments. We'll turn this one down to 6%. Enter. Let's move this one down to say a little bit high. We want it to be about 4.5 on the base. Power and energy will put to 5. Yeah, okay, that's happy with that. Now, let's move on to the next segment, which is, and the next section will be the income statement. This always starts with, again, total revenue. Just always put it equal to what we've just calculated. Growth rate. Now we go on to the EBIT. I want to know what this is as a percentage of revenue. After that, other taxes. Okay, we need to remember this page when we're doing the WACC to understand the breakdown of revenue. As in where they are by region. The actual financial statements are a bit further down. There might be 10. Here, on the proper one, is the balance sheet, cash flow statement. Okay, yeah, we can use this one. Consolidated profit, operating profit. The 12,960. This is actually a better way to have. No, I think we've done it. We've done the right way. Don't worry. Okay, so 12,966. Copying this down for the formatting. 12, 6. 13, 072, 11, 151. Divide this, the EBIT, by the total revenue. Fill it up to 2025. As you can see, the EBIT margin has compressed quite a bit in the last year. What is going on? Equals average. Sorry about that. There we go. This one is just a placeholder, so don't worry about it for now. But we'll do the proper one in the actual DCF section. Then taxes are here. Oh, sorry, we just need to do this. Again, it's a placeholder. Take your total revenue and just multiply it by the percentage of revenue, the EBIT margin, and that will give you the. So 2781, 629, 768. So the cash flow items are the depreciation and amortization, your capital expenditures, and your change in net working capital. And I'm just copying this down for the formatting. I want the cash flow statement now, which is this one, page 53. We want this line. We have to go back actually to the other one. We want this one. We're going to sum up these. And then we want the capital expenditures. So just onto the 2023 statement. Down here somewhere. Okay, so we want 2144. The capital expenditure, then we'll go into the 1988. Change in net working capital. Yes. Oh, sorry, is 1597. Change in net. We sum these up. Of course, sum. Sorry, sometimes the shift key is working and others doesn't. Negative 437, negative 364, negative 754, 796, 486, 8, negative 95, 4. I've got all of them. Back onto the other one now. Four, two, one, three, seven, negative 7, divided by the revenue. Same, yeah. Okay, let's get the cash flow items done. We're about halfway through now, just a bit over. Now this is the part where we can start putting everything together. So again, total revenue. It feels like we're repeating a lot of the things that we've done, and we are a bit. But for this next bit, what we have to do is we have to create a what we did for the revenue build, but for the EBIT. So take this one. Balls. That B17. Need to. I mean, eventually, let's say that the EBIT margin, it's what is it now? It's 15-ish%. Let's say it goes to 17. We want to know what this is as a percentage of. This has to equal what we put here. Copy that across. Go. Okay, let's sort these out first. Make sure the correct switch is activating it. And this should now equal. We're going to say, let's say 15.5 here. So we're expecting the EBIT margin to expand. Now that we can simulate the different EBIT scenarios, whether the expansion does a EBIT margin does expand or not. We can simulate the different taxes as well. So this is why this needs to be linked to this, because when we go on the bear case, we need the taxes to adjust. If it's a low EBIT, the taxes have lower. So once we have that, what we calculate next is for the EBIT, which is your earnings before interest, but after tax. You go equals, you select your EBIT, and you subtract your taxes. pull it along, and that is the earnings before interest but after tax. We then add back in our cash flow item. Put these equal to what we calculated here. C83. Do this format again. Here. Now we can calculate the unlevered free cash flow. To do that, just for the formatting, you take your EBIT, you add back in depreciation and amortization, you subtract your capex, you subtract the change in net working capital. Okay, yeah. So the unlevered free cash flow that we're forecasting for the next 5 years is, for 2026, it'll be a bit over 9 billion, and it will keep increasing until 2030, where we're expected to be nearly just under 12.5 billion. Now, what we need to do is we need to discount these cash flows back to the present day, because of the time value of money. $1 today is worth more than $1 tomorrow. So we need to build the weighted average cost of capital to give us a discount rate to see what the value of these cash flows are today. So present value of unlevered free cash. And to do this, as I said, we need to build the WACC. So before we start, for sure that's working. Yeah. Type in 0.5. Pull that along. And this is how we discount the back to the present day, because we're saying if we put 1, we would assume that all of the cash flows for Caterpillar are generated at the end of the year, but in reality they're generated throughout the year. Why we're taking the midpoint of each year. So 0.5, 1.5, 2.5, 3. So yeah, so open up a new sheet now. Zoom a bit. Don't need to freeze the pane, but put that there. So your weighted average cost of capital is your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. There we go. So the components that we need for it, we need the market cap of Caterpillar, which is easy to find. We just go equals A1 market cap, but we divide it by 1,000,000 so that the formatting is correct, because these financial statements are done in millions of dollars. There we go. So currently it's about a $353 billion company. Percentage of equity, we don't know yet. Cost of equity, again, we don't know, because it consists of the risk-free rate, the beta, and the equity risk premium. We know the risk-free rate is the US 10-year, but when we come to it, we'll sort this one out. We'll do everything in in one go rather than in small bits. Percentage of debt, we don't know that. The debt, we'll get this off the balance sheet. Cost of debt. Tax rate, again, the tax rates are in the financial statement somewhere. Can't remember what page though. This will be the total of the cost of the market cap and debt. Okay, let's take the debt first. Okay, yeah. It's this one. 5514 short-term borrowings plus long-term debt. So short-term is anything that's due within a year, and long-term is anything longer than a year. And we only want to take liabilities that are, say, interest-bearing. So it's this one plus this equals 3696 plus 5514. Format it. Go. So now we can get the total. The percentage of equity is your market cap divided by your, to a percentage, your debt divided by your total tax rate is, I actually put it somewhere. Let's I'll find it 1 second. Here it is. The effective tax rate for 2025 was 24%. The cost of debt, the way we'll work this out is on the income statement, we'll find the interest expense. This one. And we just divide it by the debt, and that will give 0 2. But 1.3, let's go 0.3864%. Okay, so that's that bit. Now we're just left with the cost of equity. We know our risk-free rate is 4.091%. And the beta. So we have to decide what industry, the industries that Caterpillar operates in. We want to know what the unlevered betas are for those industries. We need the revenues for Caterpillar from those when we break it down. Then we want the EV to sales, which will help us find the value of each respective revenue segment. Then we want the weight, and then the weighted beta. So let's first decide which industries we think Caterpillar operates in. So the machinery will be one. Sales of machinery, power, and energy. Oh, okay, so machinery will be one. Financial services could actually be another. Yeah, let's go with okay. Let's go with machinery. Even though things like metals and mining, what's the other one? And then the power and generation. But really, it is still machinery. So we'll go with that. We'll go machinery and the financial services. Write it up properly. Okay, machinery. The unlevered beta is, where is it? We want this column. 1.24. 0.28. 1.24. 0.28. 1.24. The revenues equals financial services is just EV to sales. This column 2.61 and 13.72. 2.61, 13.72. So the value of each of these revenue segments of the company is as so 167 for the machinery and 58 for financial services. It is painful using the browser, but for some reason I can't sign back into the desktop, so I'm having to use it on here. You 'The weighted beta is you just take your unlevered beta, multiply it by the weight, so 0.99, page 25. Now your equity risk premium, we need to take the region, revenues, the ERP, weight, and then weighted ERP. So we know where 32, I think it was. Here we are. Okay, so this is a nice breakdown. North America, Latin America. This is Europe, Middle East, and Africa. They get rated differently. Europe, Africa, Middle East. Then Asia Pacific. So let's go North America, LATAM. We'll call it EMEA. Let's call it the proper version rather than what they do, and APAC. We know so we know the revenues are so it's the ones down here. 3609 6988 for LATAM, 12793 for Europe, Middle East, and Africa, and those are the revenues for APAC. We can actually see which regions are growing. So APAC was growing. No, sorry, APAC declined. Middle East grew. Latin America grew, as did North America. So for North America, let's pull up our risk premiums for countries. So for North America, it's 4.45%. For LATAM, you go Central and South America. Let's go 8.63. Europe, Middle East, and Africa has its own one here, 5.91. Then APAC is Asia, 5.72. Take your ERP and you multiply it by your weight. So 7. Here. So now your cost of equity is, take your risk-free rate plus your beta multiplied by your equity risk premium. What we're going to do, take your risk-free rate plus your beta multiplied by your equity risk, 9.42%. Now we have all of the components that we need to calculate our WACC. We're going to use this formula, percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. So we go, let's split it into two though with brackets. Percentage of equity multiplied by your cost of equity close brackets, plus, open new brackets, percentage of debt multiplied by your cost of debt, multiplied by 1 minus your tax rate, close brackets, and we have a WACC of 8.64%. So come back onto this page, go for the bear case. We're going to say we'll add 0.5% on. And for the bull, we take away 0.5%. For the terminal growth value, we're going to say 3%. The bull will add 0.5% onto that. For the bear, we will subtract. Now, again, in the same way we use the switches for here, we want them to apply to the WACC and the terminal growth value. But we're going to use a different function. Choose. So your equals choose, open brackets, select the switch, then each of these in order. Just need to format it into percentage. Go. Let's copy this down for the terminal growth value. Great. Now that we have these, let's discount our cash flows back to the present day. So equals, take your unlevered free cash flow divided by 1 plus your WACC, but lock the WACC in, close brackets, to the power. Yeah, that's good. Format it. And there we have it. So we've discounted our cash flows. Sorry, it doesn't. Oh, okay, well, yeah. Now the terminal value is you take your final year of unlevered free cash flow, multiply it by 1 plus your growth rate, or terminal growth value, divided by your WACC, take away your terminal growth value. Okay. And again, we have to discount this back to today, PV of TV, present value of terminal value, divide by plus your WACC to the power the final year. Okay. Take your terminal value and sum up all the present value of the unlevered free cash flows. That gives us 199 billion. So we add back in our cash and we subtract our debt. We know what our debt is because we have calculated it for the WACC. So let's put it equal to that. Then for the cash, let's get onto the balance sheet, which is somewhere down here. We want this 9980. Anything else? Yeah, no, that's it. We'll take your enterprise value, add back in your cash, subtract your debt. So we have it 17172, about 170 billion. We then find the diluted shares. Diluted shares outstanding, which will lead to our implied share price. The dividend. Yep. Go 472.3. The reason why I'm copying this down is just for the formatting, because the shortcut's not working on the browser version. Get the implied share price, you just take your, this is encouraging before we go on to that, the share count is decreasing because this is they do quite aggressive buybacks. Equals take your equity value and divide it by your diluted shares outstanding. That gives us I accidentally pressed one of the formatting formulas, but obviously it opens a console on this rather than copies the format. Okay, so 366, J126. Okay, so the base case for this, if we're looking at these forecasts for the revenue and the EBIT, would be about $365. That's about a 50% drop from where it is now. Let's just have a quick click on here. And I guess one thing you can say is that that would give it a fair value pretty much between the 50-week and the 200-week moving average. Let's, if we go onto a bull case, where do we? Would be 507 on the bull case. So they must be really optimistic, I guess, about this part with the data center demand, and that the well, all mining is going to continue to rally. So, didn't even want to look at what the bear case would be. 285. And this on the bear case is about where it was when the low of the Liberation Day tariffs. So, interesting. Obviously, put your own growth forecast in, do your own research. This is not financial advice, but it's good to learn how to build out these models so that you can build them for whichever company you choose to analyze, and it should give you a good idea of where the company's heading from revenue, from an EBIT. Then you can decide how to invest, but this is not financial. But yeah, that's it for today. Thank you for watching, and I'll see you on the next one. Thanks. Bye.